You're not imagining it, okay? You're not bad with money, and you're definitely not financially irresponsible just because loans feel heavy in your life, while other people seem to use loans like stepping stones. If you've ever looked around and thought, if money is cheap right now, why does it never feel cheap for me? Yeah, that feeling is real, like dead real. And today, we're going to unpack something most people feel but can't explain. Because once you see how lending actually works in the real world, not in ads, not in hype finance posts, not in rise and grind TikToks, but inside the system itself, you can't unsee it. And that moment, when confusion turns into clarity, that's usually where real financial change starts. Imagine we're standing in front of a whiteboard together. I draw two stick figures. Same country, same banks, same interest rate environment, same economic news saying, yo, rates are low, borrowing is cheap. Sounds sweet, right? But here's the twist. One of those figures uses loans to get richer. The other uses loans just to stay afloat. That difference is usually not intelligence, not effort, not who wakes up at 5 a.m. or who hustles harder. Nah, it's about positioning inside the financial system. Cheap loans are not just about interest rates. They're about safety, timing, assets, stability, and what happens if life punches you in the face for even 1 month. Let's talk about the feeling first, because feelings around money, that's data. When someone already wealthy takes a loan, they usually feel strategic, calm, in control, like they're moving pieces on a chessboard. When someone living paycheck to paycheck takes a loan, it often feels like survival mode, like holding your breath underwater, hoping you hit the surface before your lungs give out. That emotional difference is not weakness. It's not you being bad with money. That emotional difference is math, mixed with system design. If missing one payment could wreck your stability, that loan is not cheap for you, even if the interest rate looks low on paper. Straight up. Most of us grew up hearing simple advice. Study hard, work hard, avoid bad debt, maybe use good debt. Cool, sounds nice, but nobody explains what actually makes debt good or bad in real life. Because the truth, debt behaves differently depending on who is holding it. The same loan can be a wealth-building tool for one person and a long-term trap for another. And the difference usually comes down to margin, the space between your income and your survival expenses. Now, let's move to whiteboard math. Don't worry, no crazy formulas, just real-life numbers. Imagine two people borrow the same amount of money at the same interest rate. On paper, same cost. But what really matters is what that borrowed money is doing. If someone borrows money to cover rent, medical bills, or emergencies, that loan is not producing financial return. It's solving a survival problem. And hey, survival borrowing is sometimes necessary. No shame in that. But it does not create growth. Meanwhile, someone else might borrow money to buy an asset, invest in a business, or fund something that produces income. Now the loan is working for them instead of against them. Let's say someone borrows money at 5% interest. If that money is used to buy something producing 12% returns, they're winning. They're paying 5 to make 12. That's a power move. But if someone borrows at 5% just to survive, they're paying 5% for zero financial return. Same rate, completely different outcome. And that right there is the first big reason cheap loans feel different depending on your financial position. Now, add another whiteboard circle, risk cost. If someone has strong savings and stable income, a loan is low risk. If life throws chaos their way, they can still make payments. But if someone has no savings and unstable income, that same loan is high risk. And risk always makes borrowing more expensive in real life, even if the interest rate is technically low. Because one missed payment can trigger fees, credit damage, panic decisions, and sometimes even more borrowing just to stay current. That's stressful, bro, for real. Now let's talk about time. Time is one of the biggest invisible flexes in finance. People with wealth, they usually have time. They can wait for investments to grow. They can refinance. They can negotiate. They can ride out bad economic seasons. Someone living paycheck to paycheck, they often can't wait. They need solutions right now. And short-term borrowing almost always costs more than long-term strategic borrowing. Always. Another huge factor is collateral. Banks love security, like love it. If you already own assets, property, investments, business equity, banks see you as safer, and safer borrowers get cheaper loans. Not because they're better humans, not because they grind harder, because statistically, they default less. The system is built on probability, not fairness, and wealth historically predicts repayment safety, so wealth gets rewarded with cheaper money. That's just how the game is set up. There's also something most people don't see: relationship advantage. People with higher wealth often have long-term bank relationships. They get better offers, flexible payment structures, private deals. If they hit financial trouble, they often get options. Someone new to borrowing, they usually get rigid terms and zero mercy penalties. Same concept, loan, totally different experience. Information is another hidden layer. Wealthier borrowers often have advisors, accountants, financial planners. They structure loans around taxes, investment timing, asset growth. Many normal borrowers are making loan decisions solo, using online calculators and vibes, and information itself makes borrowing cheaper, period. Scale also matters. When someone borrows big money at low rates, even small advantages multiply like crazy. When someone borrows small amounts, rate improvements help, sure, but they don't change life trajectory the same way. Scale amplifies financial advantage, big time. Now, let's zoom out to the system level, because this is not just about personal choices. The lending system is designed to protect lenders first. That's not evil, that's business. Banks price loans based on risk probability. If data says certain financial profiles default less, those profiles get cheaper loans. Over time, this creates a cycle. Stability gets rewarded with more stability. Instability gets punished with higher costs. It snowballs. There's also asset inflation. Over long time periods, assets like real estate and stocks tend to go up. People who can borrow cheaply to buy assets, they benefit from that long-term growth. People who can only borrow for consumption, they miss that compounding wave. Cheap loans are most powerful when used to buy things that grow in value, and wealthier borrowers are usually positioned to do that more often. Now listen, this part matters. This is not about blame. A lot of people think if I just learned finance earlier, I'd be fine. But systems shape behavior. If you grow up without exposure to asset-based borrowing, you naturally use loans for survival or smoothing life expenses. That's normal. That's human. The key is awareness, moving forward. So what's the exit strategy? Not a miracle hack, not some get-rich-overnight nonsense. More like changing how you see borrowing. First, redefine what cheap debt means for you. Cheap debt is not just low interest. Cheap debt is debt that increases your future earning power or asset ownership. Education that realistically boosts income? Maybe. Business investment with real planning? Maybe. Asset ownership with long-term growth history? Maybe. Second, build shock absorbers. Savings are boring, not sexy, not Instagram flex material, but savings completely change how loans behave in your life. Savings reduce panic decisions, reduce default risk, give negotiation power. Even small emergency funds, game changer, for real. Third, improve credit positioning slowly. You don't need perfect credit. Consistent on-time payments matter way more. Over time, better credit lowers borrowing costs. Lower borrowing costs create better opportunities. It's slow, yeah, but it compounds like crazy. Fourth, shift towards asset-first thinking. Before taking a loan, ask, does this create income, skills, or ownership, or does it only remove today's stress? Sometimes removing stress is necessary. Life happens, but knowing the difference changes long-term outcomes. Now, let's close this out, heart to heart. If you've ever felt like cheap money exists, but somehow never for you, you weren't crazy. You were noticing something real. The financial world often gives the best terms to people who need them the least. Sounds harsh, but understanding that is not depressing. It's power. Because once you understand system rules, you can start positioning yourself differently inside it. You don't need to become ultra rich to benefit from this knowledge. Even small shifts matter. Building savings buffers, improving credit history, using debt for growth when possible, avoiding high-risk survival debt when possible. These small moves, they change how the system treats you over time. Here's the final whiteboard sentence. Cheap loans are not just about interest rates. They're about margin, assets, time,
information, and resilience. The more of those you build, even slowly, the cheaper money becomes for you too. Real financial change doesn't start when you suddenly get rich. It starts when you finally see the system clearly. Because once you see it, you stop blaming yourself for structural stuff and you start focusing energy on what you can control. And once you see it, you really can't unsee it. And that's not scary. That's power. All right, if this hit home for you, you already know the vibe. Hit like, subscribe to the channel, and yeah, tap that bell icon so you don't miss what's coming next.